on-chain that represents value. Bitcoin is Bitcoin. A real decentralization of capital market, decentralized ledger, the mechanism by which private market assets come on-chain. And it's not yet good. Billion of assets on our platform. We're around 170 million. BitMEX and Arthur Hayes and Ben and trade at about 5.2 trillion a day.
Invenium in one line, why it's different, and how are you adopting tokenization? Now I want to talk about your baby. I want to talk about Invenium. Invenium in one line, why it's different, and how are you adopting tokenization today? I know, maybe my audience don't, so tell us more.
Yeah, sure. Well, first off, thanks for asking me. So in a decentralized world where you have something on chain that represents value, again, if there's no entropy in that thing, meaning Bitcoin is Bitcoin. There might be entropy in the network, but one Bitcoin is one Bitcoin, and the only variable is the decimalization or the floating point. How many Bitcoins you own? Well, that's kind of easy. We're going to trade that. That's going to go back and forth. But if you start trading something that has any type of entropy in it, I'm owning an apartment building, or I own a portfolio of apartment buildings. There's entropy in those assets, and you need to understand the state of the asset, and understand the state of the data, so you can understand the state of the asset, so you can value the asset, so you can value the capital stack, so you can trade the capital stack, and that thing that's on chain and has value is there. Well, even if we have a decentralized ledger and we have centralized compute and we have centralized data where we're only pointing to referenceable data sets in the middle, it's still the same thing. They just caught us in a centralized choke point in a different place. The real decentralization of capital markets, where you're going to have true globalization, where people are going to be able to deploy capital into different tools in different jurisdictions, but at scale on a data-driven way, is a decentralized data environment, decentralized compute functionality on decentralized ledgers. And when that happens, those instruments will be incarnated in different jurisdictions. Invenium is how you have everything from the token to the asset. How do you understand the state of the asset that backs it up in a fully decentralized manner where the GP or the asset owner controls their own data and they haven't given control away to a centralized database? And so this is the mechanism by which private market assets come on chain, right? And so we are that decentralized data solution that feeds decentralized compute that informs that instrument on decentralized ledgers.
Love that. Because we're talking about tokenization, you've been starting tokenization 2016, 2017. Nobody was talking about it. Why out of nowhere? Maybe it's not out of nowhere, but why every day we have an article written since the last 9 months about tokenization, not 4 years ago? What changed? What happened?
Because there's a ton of people working on it, and it's starting to get good. And it's not yet good, but it's getting there. And at some point soon it will be excellent. But we're not there yet. And the reason is, I think the macro environment, the products are getting better. The macro environment is getting good. The early adopters are coming in. And I think that the success of the crypto market really is a driver for a lot of this value around tokenization. And the reality is, you look at the tokenization of real world assets right now, everything that they're talking about is tokenization of something with a centralized ledger, meaning an Edgar database that is pointing to all their data in one place. And so it's something that's already liquid, it's already trading pretty efficiently, but it's now touching this new crypto marketplace that's going to go back and forth around the reserves. When we really are going to have this quantum leap is when we take this marketplace, which is, depending on your estimate, 500 to 600% bigger than the public markets, which are the private markets, and then you bring that in, and the derivatives markets are about 3 times bigger than public markets. If we can have a derivatives marketplace that is of the private market assets, and let's say not for the 500 to 600, but 2% or 200 times the size of the public markets. So just the top 1/3 of it. And then we're 3 times the size of that. We're going to have a derivatives market on private market assets that are going to allow you to hedge, trade, and monetize illiquid asset without having to change the ownership of the underlying. At that point, that's when real world assets and tokenization is going to explode. That's the future where tokenization is, and that's all of that is focused on. All derivatives markets for alternatives in order to create liquidity around better pricing, around better data, for everything from indices to creating repo markets for the, and the value of collateral. And this is where we have big institutional players who are coming in at scale, and that's what Invention is focused on right now. And so why tokenization now? It's 8 years of hard work. We're almost at an overnight success. You know what I mean?
100%. I love that. And talking about tokenization, following up more on that, everybody's talking about the lowest hanging fruits. Everybody wants to tackle that. What do you think? What are the lowest hanging fruits? What are the immediate needs today? Let's focus more on enterprise level. I guess this is your forte. What can you say about that?
I'm going to say three things. Number one, this year we'll break about. Our goal at the beginning of the year was to hit 150 billion of assets on our platform. I think our target right now, if I had to say where we'll end the year, it'll be around 170 billion. So we are getting meaningful adoption from big entities using our tool to give them better price discovery, how to mark their asset better in all sorts of different ways. Now, they're not trading those instruments, they're informing those assets, getting them ready from the middle and back office so that when the front office is available, they can start to trade it. Well, in Bennion, we believe that the derivatives marketplace is going to be the thing that takes off. We are focused on that. We're launching the world's first commercial real estate derivatives marketplace. We're working with regulators right now to get approvals. We have some really amazing partners who are helping us get there. But we think the derivatives marketplace is the place that can scale first. We're looking at real estate and then private equity, private credit, and infrastructure derivatives. But we're doing that in partnership with a lot of the crypto derivatives players. And so this is what we're doing, and I think that's where everything's going to take off.
Do you think derivatives, mostly because we're talking about institutions, mostly financial services, so mostly regulatory bodies, SEC, CFTC. So do you think derivatives, because they are not getting exposed to the asset itself, more the underlying, is this the rationale behind it? So lesser regulation, or you have another perspective theory about that? I'm not sure if I'm making sense there.
Yeah, no, absolutely you are. And maybe for the listener, I'll describe it a little bit more, right? When you have an underlying asset, that's a very large asset. In 1992, Schiller came up with this idea of a perpetuals contract, right? And he did this for real estate as a way of a perpetual futures contract. So I own a building worth $1 billion. That building has many, many pieces of the capital stack. Selling it is very expensive. The tax on it is huge. The transfer tax on it is huge. So if I want to gain some liquidity, I don't want to sell the underlying, which is what you're referring to, right? The primary asset. But I want to gain liquidity. How would I do it? So he wrote a paper in 1992, published in 93, became very famous about perpetuals, right? Where that building owner would get another building owner. They'd agree on a pricing mechanism. What they would say is, neither one of us are going to sell it. But what we're going to do is we're going to pair this asset against each other. And we both agree on a valuation methodology. And if this building goes up in value, I, the one who owns the building that didn't go up in value as much, I have to layer cash in so that my contract and your contract maintain equilibrium. And what happened is that they can do this. This was an idea that existed in academia for many years until 2011. Some of the people were trying to create perpetual forward contracts for crypto as a mechanism, but it wasn't until BitMEX and Arthur Hayes and Ben and Sam and those guys said, well, we're going to launch this because they tinkered with it and came up with all these different things until they got it exactly right. And then in a period of 6 years, $11 trillion of trading flew through those perpetuals. And then that's just on their platform. On Binance, they're doing 40 billion. Right now they're doing about 40 billion a day of throughput. You go, that's just a huge number. But when you think about fixed income derivatives trade about 5.2 trillion a day, right? So you just go, we're an order of magnitude below that, right? We're at 80 basis points of what just fixed income interest rate derivatives trade daily, right? So the room for growth is huge, but the derivative allows you to trade and monetize value and de-risk your assets. So now if I own this building or I own this building, either one, my risk exposure is against both, not just one, right? And so I've de-risked my asset. Now if I take this $1 billion building and I do a forward perpetual contract against 4 other buildings, I'm gonna have to post some cash if my building goes down. But the point is, I've now de-risked and I now effectively own a portfolio of 6 buildings instead of 1. And so I've de-risked my asset, even though I still own my asset entirely. So I own the underlying, and what I'm doing is using derivatives as a mechanism to de-risk and create liquidity. I can do this so the first things that we're launching are these indices of entire cities, where we have a data exchange. We're working with some of our big partners, as you know, Fisher & Wakefield they led our last round of investment a couple of years ago, where we're creating a data exchange where we're going to be able to create indices around individual cities. So if I'm Brookfield and I own 600 million in San Francisco, and I want to go short San Francisco and go long Miami commercial real estate, that's a 24-month disposition. But if I can say I'm going to go short 600 million in San Francisco tomorrow using indices and long 600 million in Miami, and then I slowly naturally cover my short as I sell my buildings. Does that make sense? And I pare down my long as I buy the underlying. Suddenly I have the ability to implement my economic thesis, even though the transfer of the underlying might take 24 months, which in real estate is what it takes.